Alrighty. Okay, we're live. We're good. We're live on all those places, all on social media. I'm Paul Archer. Welcome to my mortgage live stream. I hope everybody's well. We seem to be online to all the places, so that's all good news all round. So what we're going to do is crack on and give you some content. So I want to talk about the budget. Everybody else is, so why don't I do so too? Daft, isn't it, really? And I also want to talk about income tax on personal allowances and pick up on dividend tax as well. It's a bit of an update for you, really, with the new tax year. So we had the budget last year and everybody was talking about it, and everyone wants to talk about the implications for mortgage advisors. And that's what I want to do right now. But I hope you're fine. Hope you're okay. Hope you're enjoying the half-term week from kids off school. If you have kids, great. Hope you get a nice time and you're enjoying yourself at the moment. So, mortgage advisor implications for the budget. Well, first of all, what really happened in the budget that affects mortgage advisors and the mortgage market? Not a lot. If truth be told, we thought he was going to tinkle with pension allowances. We thought he was going to tinkle with capital gains tax to affect the buy-to-let market, but he's done none of those things. I think because he's upped the old taxes a bit too much recently, and he doesn't want to do it so much anymore, which is probably fair enough, isn't it? Because he's probably a bit worried and concerned about what's going on. But what he has done, though, has had a massive impact for the next few years. And I think we need to understand this. So what I'm going to do now is just head over to whiteboard now for you and just tell you what's going on, really, and as a mortgage advisor, what you need to be aware of. So let's head over to our whiteboard over here in whiteboard land for you. So why not? Because we can't we? Now, the whole point about the budget is it works out government's kind of like spending position, really, for the next year or so. And Rishi did exactly the same. He hasn't made any changes to taxes and things to affect the mortgage market directly. But what he has done, though, is he's carrying on with his spending. And you're quite seeing all the numbers, and he's putting money into the NHS, into care, into transport, into roads and railways. And he's shoving money everywhere into the economy. And it sounds great. Whether it's a vote-winning thing, I don't know. But the fact is, he's doing it. So what have we got? We've got this thing in our country called GDP, or gross domestic product, which you're aware of. Now, GDP is how we measure our economy. Now, the statisticians from the Office of National Statistics, these are the people who know about numbers, they reckon that we're doing really well as an economy post-COVID. This year, 2021, our GDP is going to grow by 6.5%, which is unheard of, really, unless you live in China or India. But in the UK, it never normally does that. It's just about a couple of percent a year at the very best. Because we had the COVID shutdown, so we've had a lot of resuming business again. But next year, which is an interesting one, they reckon that GDP is going to be up by about 6% next year, which is brilliant for the economy. And that's why, you see, they can actually afford to spend. Because they reckon that pre-COVID GDP is going to be reached again early 2022. So in other words, we've made up for lost time plus more. And what that does, of course, is it gets the economy booming. And when the economy booms and everyone's at work, the government make a lot of money through tax receipts. People don't really appreciate that. In recession, of course, tax receipts go right down. But the government's making a shed full of money on tax receipts, and more in the future, as well as the personal allowance thresholds don't get changed. They'll make more and more money. Which means Rishi's got money to spend, and he's going to spend it. But what does spending do? Well, all that government spending does, let's put that over here, the government spending. I mean, he's spending billions, isn't he? All he's doing with government spending is he's putting money into the economy. That's all he's doing. He's putting a lot of money in the economy, which bubbles, which makes things happen, which creates jobs. It creates the economy growing. So his spending is having an impact on increasing GDP. And that's a good thing. But here lieth the problem. This government spending has got to be funded. We know that. It's got to be funded by taxation receipts, which he's making a lot of. But he's still borrowing. He's still borrowing large amounts of money. He's still doing quantitative easing. QE, of course, is where we print money until the end of this year. That's his plan, which is fine. I get all of that. But the Bank of England now owns a third of government stock. A third of the government's debt, which is like trillions, a third of that's actually owned by the Bank of England. So the government kind of owns its own stock, which sounds a bit daft. They're going to stop doing that, and they're going to gradually next year start flogging back all these bonds the Bank of England owns to the market, the market which buys stocks and things like that. So that's going to have a bit of an impact. So let's just look at this, what's going on then that's going to affect us. Now, Great Britain, UK, is particularly susceptible to inflationary pressure right now. You've read about it in the news. We use a lot of gas, for example. We have a lot of services. A lot of our wages now are under pressure. People want to put their salaries up, their incomes up, because prices going up left, right and centre. Inflation hit 3%. So we are under a lot of inflationary pressure at the moment. And that ain't going to go down. So what happens, you see, when there's inflation? As you know, the Bank of England have a 2% target. There you go. In other words, they mustn't let inflation rise above 2%. Awful. If it does go above 2%, they have to use monetary policies to combat it. Monetarism. Now, monetarism, of course, is all about reducing the money supply. It's about contracting all the dough that's in the economy. It's about putting interest rates up so that lending becomes expensive and businesses and consumers don't borrow so much. It's mostly businesses. Therefore, that dampens the economy and that reduces inflation. That's the plan, isn't it? Makes sense. But of course, they've been doing QE up to now because interest rates are so low. So the Bank of England have let out the signals, or Bailey's been talking to the market, and the market have run with it, really, because short-term bond rates have gone up to 0.65%. The market's starting to increase its own rates. Some of the lenders, you probably noticed, have started to push up their rates a little bit, just a little tad, even before the Bank of England. Because often when the Bank of England says they're going to increase interest rates, the market kind of takes care of things, doesn't it? And that's happening. 2022, we'll probably see Bank of England base rate at about the 1% mark at some point at the end of the year. That's going to have an impact on all sorts of aspects in our business, of course, because mortgage rates will go up. The banks like to make their little margins, don't they? Which is fair enough, because they do report to shareholders, not to the public, and therefore they should. So, of course, rates are going to go up, and that would affect the mortgage market. But I think you know that. But here's the interesting thing. This is the big one. Have you ever had a bath where you jump in the bath and you start running the tap, and you go away, make a cup of tea or whatever, and you come back and the bath's hardly gone up because you left the plug out? Possibly. Most people wouldn't, of course. But that's what's happening. We're running a bath with the plug out. So we're trying to run the bath, the water's going down the plug. Because what's happening, you see, logically, the Bank of England are raising interest rates. They're kind of compressing the economy. Monetarism is about restricting the money supply. They're trying to dampen the economy. They're trying to bring inflation down, which is the key. And meanwhile, of course, there's lots of inflationary pressures, and the government are spending. You see, they've got fiscal spending going on with monetarism that's combating it. It's like having a bath with a plug out, because this spending the government are doing is just going to increase the economy. It's going to cause inflationary pressures. And of course, over here, you've got interest rates going up. It's a bit of a storm, isn't it? I don't know what's going to happen, but I think inflation might well start to really trickle upwards. Because this government spending, people's wages going up, inflationary pressures from around the world. Well, what good interest rates will do, I don't know, but I can see inflation starting to become a real big problem, and that will mean interest rates heading northwards as well. So that's the impact of the budget, really. It's not like, sparkling wine having a reduction and stuff like that. There's no other changes, but it's this big one here. It's government spending, lots of spending. It's fiscal spending. You see, normally what would happen when they increase interest rates, government stops spending. They contract the public sector, but the government are increasing it. And fair play to them. They've got the dough to do it. They've been printing it. They've got plenty of money to spend. They've got tax receipts coming in. It's a funny old system. But there's the budget update for you. Hope that's been useful. Bye. Okay, let's flick back over here, shall we? Because that's been quite an interesting subject, that one, isn't it? For you to enjoy. Yeah, okay. Well, let's get on to a couple of other topics, really, which come into the changes in the syllabus to CMAP. So this is if you're like a CMAP person and you may have passed your exams and you want a bit of an update. What I want to do now is give you a bit of an update on personal allowances and dividend taxation for the new tax year, just to give you a rough idea of what's going on, really. So flick back over to our chart here. So I'm going to just rub this out for you. We're going to take a look at personal allowances for you. There you go. An update on personal allowances. Now, we're into the tax year 21-22. Some of you may not be, some of you will be. But when it comes to paying income tax, which most of us have to pay, there is this lovely thing called personal allowances or allowances. Now, there's loads of different allowances that the government allow to offset income tax. So let's put a title up here to start with, shall we? And we'll see that all is going well. We're talking about personal allowances. There you go. Personal allowances. Now, for those of you doing the exam, or those of you revising for the exam, you know full well that you get a load of tax sheet information. So, I've got information here, for example, on the tax sheet. And this tells me all the different allowances. And there's 3 or 4 really that we need to be aware of. They're in the tax sheet, don't you remember them? You've got the personal allowance itself, which I want to take a look at, which is the 12,570 this year. You've also got a marriage allowance, which allows you to transfer some of your money from a non-earning spouse to you as well, or civil partner. You've got rent a room allowance, 7,500. In other words, somebody can actually earn money from renting a room in the property. There's lots of allowances, really. There's also the income limit for personal allowance as well, which is what I want to talk about in this session. So personal allowance, then what is it? Well, it's an annual figure which you can use to offset your income tax, pure and simple as that. It's 12,570 for this tax year. So you can earn up to that amount of money and pay no income tax. And then you have your basic rate tax, and then you have a higher rate tax. We've got some calculations in the boot camp to show you this. But you've got to be aware that people earning over 100 grand actually lose their personal allowance. So a couple of important figures there for you. It's great having a personal allowance, and as I said to you, it's 12,570. But that's in the tax sheet. Don't need to know that. But anybody earning over £100,000, 100k, will start to lose their personal allowance, and that's the message, really. And how it works is quite simple. For every £2 you earn over 100,000, you lose £1 of your personal allowance. So let's just take an example for you. Let's just give you an example of Janine, who is our case study. Now, Janine has a salary of 110,000, which is jolly nice, isn't it? I'd like to have that, wouldn't you? Now, she's over the 100 grand mark, and she's over by 10,000. Remember, it's for every £2 that you earn over, you use £1. So she's going to lose £5,000 from her personal allowance. That's coming off her PA, which brings her personal allowance down. Just do the math: 12,570 less 5,000. That gives you a personal allowance now of £7,570. That's her new personal allowance. And eventually, of course, she'll start to lose it completely, because if she earns more money, she starts to lose more of the personal allowance. And I suppose somebody earning that sort of money shouldn't really have a personal allowance. They've got the dough to afford it, so why not? But you need to appreciate and understand that. Now, would you need to work out a calculation? Not in the exam. They're not going to do that to you. People think the CMAP exam is full of calculations. It's not. It really isn't. The book is, because they like to tell you to do calculations to test your knowledge, and it's not a bad thing. So let's just take a quick look at how this would work for Janine. Now, as you know, I'm a big fan of my little bucket system. So there's my little bucket there for you. Now, Janine, of course, has a tax-free income of 7,570, as we've just done there. £7,570 of her income is tax-free. So let's just put that in there for you, because that's great. Now, Janine, of course, will need to pay basic rate tax, and the basic rate amounts now. There's there's a band, isn't there? A basic rate, then there's a band of higher rate, and it goes upwards to additional rate. Now again, look at the tax sheet. It tells you that there's a maximum of 37,700 at 20%. So that's the band of basic rate. Let's put a little figure in there. So that's the first calculation you're going to do. Now, obviously, we've got our income of 110. We've got 37,700 at 20%. We've got 7.5 virtually at tax-free. So that leaves, if you worked out the numbers, 64,730 at 40% tax, which is what she's got to pay. So if you wanted to work out the numbers, obviously 64 plus 37 plus 7 gives you 110, which is fair enough, isn't it? And then you just work out 37 at 20, 64 at 40, and that's the amount of income tax that Janine will have to pay. And, you know, to understand the calculation, people often have to do that. You won't get that in the exam itself. Of course you won't. You might get it in a higher level tax exam, an RO, for example, or a diploma exam, but not for level 3 CMAP. This is understanding how the tax-free bit works, really. One thing to mention at this point before I wrap up, really, is that you as a mortgage advisor can't really help here, but if you were a financial advisor, you could do something here with this client. And one of the best things you want to do here for Janine is encourage her to pay into a personal pension. Depends what she's got, of course, what kind of pension arrangement she has. But if she could put money into a SIP or a personal pension, same thing really, then she can actually reduce all of this and reduce her income effectively is what it does. So say, for example, you encourage Janine to put, say, 10 grand into a pension, £10,000 into a pension contribution, there you go, as a lump sum. Then effectively, the way it works is it reduces her salary down to 100,000. So of course, now she ain't going to lose her personal allowance. So she gets a full allowance now, tax-free allowance. Plus, she's going to get 40% tax relief on the 10 grand. So you need to work out the numbers. That's a huge amount of tax relief she's getting by paying a £10,000 pension. Not only is she getting her full tax-free allowance, which is back up to the 12,570, she's actually getting 40% relief on all of the 10 grand. She's a high rate taxpayer. So it shows you the value of paying into a personal pension, particularly at this marginal rate. But an IFA would do that, a pension planner would do that, and all good mortgage advisors, of course, would have a conduit, wouldn't you, to refer people. And you should do too, because that's the way it works. And that's personal allowances. Hope that's been useful. Bye. There you go. So that's a little example there for you of one of our topics. Now, of course, in our boot camp, CMAP Bootcamp, we have tons of these videos which we give you access to, so you can understand the whole topic as well. And what I would like to do, though, is another little topic for you on dividends, just to finish things off for you. So let's head over to our whiteboard again for you, and we'll give this a bit of a rub out for you. I want to get on to dividends. These are really just snippets, really, and updates for those of you watching these live streams, because that's what we wanted to help you out. Dividend tax, then. Again, I'm going to keep this. I'm going to keep this as practical and logical for mortgage advisors as possible, because at the end of the day, that's why you're doing CMAP. You're not doing it for any other reason. You want to be a mortgage advisor. So you've got to think about where this is useful to a mortgage advisor. Again, you're not an accountant. In the exam, you're not going to be working out massively complicated calculations, but you do need to understand it, because you will get people that are paid in dividends. And I'll share this with you as well. So we're talking here about dividends and tax is my topic. Again, we're in the 21-22 tax year, just to keep you up to speed, really. Now, a dividend, as you appreciate, is given to somebody who owns a share. Now, a share, of course, is in a company, is a proportion of a company that you own. And you can own shares in their own right. You can own them through a unit trust, through an OIC, an investment trust. There's various ways in which you can own shares, through an ISA as well, if you want to. Now, if you have shares, then you should get dividends. Dividends, of course, are the profits that people or companies make and they give them to shareholders in the form of dividends. So if you are a shareholder, you will get dividends, but also, and the big one for us, we're not really worried about shareholders, are we? But most shareholders don't go for mortgages, do they? But if you are an owner-director of your own business, then you will pay yourself dividends. Because an owner-director of their business, apparently there's about 2 million of these dudes out there who actually own their own company and therefore pay themselves dividends. I think there's more than two. There's 2 million companies, so there's obviously going to be more than one director to most companies. Now, the point is, you see, you may have these people come to you for mortgages. And you might have, for example, somebody who gets a very small salary, but they pay themselves a lot of dividends as their remuneration. And therefore, these dividends are going to be taxed. And you need to kind of understand how they're taxed as well, and that's important to you. So the government charge dividend tax at a completely different rate, and that's entirely up to them. They got different rates, and again, I've got the tax sheet here, which gives you access to the information. But the way it works is that if you're a basic rate taxpayer, any dividends that you pay yourself or you receive from owning shares are paid at 7.5% tax. That's pretty low, isn't it? Then if you're a higher rate taxpayer, it jumps massively to 32.5%, an additional rate taxpayer right up to 38.1%. Now it's going up next year. They're adding another 1.25% to pay for all the care and NHS and stuff like that, a temporary sort of increase. So it's going up quite considerably. Well, 1.25% is not much, is it? So there's certain rates there going on. And what you need to be aware of is when are dividends actually taxed, and therefore what rate would apply. Because there is a strict order of taxation when it comes to paying tax. And I'll share with you the order because it's quite important, really. So the first part of any tax calculation would be somebody's earned income. So you work out somebody's salary, maybe profits from self-employment. You might have rent from a property. You might have pension income. These are all earned income. In other words, income you're earning as such, and that's taxed first. So you get your personal allowance comes off of that. You get all your bandings, basic, high rate, etc. We've done all that before. The next one they use are savings. Let's get a different pen here so you can see how it works out. The second one are savings. Now, savings income is mostly interest, of course, on deposits and stuff like that. You do have an allowance for savings income. You have £1,500 according to your tax rate, where you don't have to pay tax, but that's added on top of it, you see. So we've already worked out your tax position from your income, and now we whack on your savings. So somebody could very quickly be a high rate taxpayer. And number 3, we then add your dividends. There you go. Your dividends get added on as the third one. So as you can probably appreciate, if you're earning other money other than just shares, then you're going to have probably a higher rate tax band from the income you're earning. So dividends getting added on number 3 means it's going to be applied at the higher rate. Just to finish off the story for you, the fourth one is capital gains, which is why most capital gains tax is high rate. Because most capital gains tax people who are liable to it have already got income from other sources. So it's kind of like adding it on, isn't it? So you can see that you get salary first, profits, etc. You get your savings next, and then you get your divs on top. So divs often come in quite expensive. So let's take a look at how one of your clients might work and see how this pans out for you. You're a mortgage advisor, and you've got somebody comes along to see you, and they own their own company, and maybe they're a management consultant or something like that, and they own their own company, and they're the owner director of the business. Maybe it's their own business on their own. So they might, for example, therefore pay themselves some money. Now, more than likely, they're going to pay themselves a small salary. So the salary is what they're going to pay themselves under the PAYE. That's how they tend to roll, isn't it? And what they do, if they're clever, is they'll pay themselves a salary, probably about 12,500 or something like that, which is below the personal allowance for income, as we know. So you get a personal allowance of 12,570, so you don't pay income tax. So they'll not pay any income tax on that. They will pay a little bit of national insurance on that, Not a lot because it's above the upper earnings limit and stuff, but they will pay a little bit of national insurance to get their stamp for the year, and obviously that's going up a little bit for them as well. But that's not a big deal because there's no income tax to pay. But of course, that's eating up their personal allowance effectively, or a lot of it anyway. Now, what this person would then do is pay themselves a big chunk of dividends. And if they're earning good money, say for example, they've got themselves a good bit of profits, they might have something like £70,000 in dividends. Obviously, they've got shares behind the scenes that pay these dividends, but that's based upon the firm they run themselves. So they're earning the profit, but they pay themselves dividends. Now, as a mortgage advisor, you need to find a lender that will take both into account and treat both as salary effectively. So you want to add the two together and use that into the decision in principle engine. That's your plan, obviously. Now, how much tax would this dude pay? Well, think about it. They're going to pay pretty much hardly anything nothing at all on their 12.5. But of course, that's eating up the personal allowance. So they're going to be into the basic rate band, and the basic rate band is what, 37.7, isn't it? So they're going to be paying quite a lot of dividend tax at basic rate, and then they're going to pay a large amount at the higher rate. So about £7,000 at dividend rate. So that's what, 7.5% they'll pay. And then the higher rate, 32.5, they're going to be paying another sort of 30,000 as well. So this guy pays dividends at the basic rate at 7.5, and then at the higher rate of 32.5%. There is a dividend allowance of £2,000, which means that you won't pay tax on all the 70. So you take 2,000 off of that to give them 68,000, and then you work out the tax on that. So there's a £2,000 dividend allowance, which is not much really. But as you can see, this person will pay basic rate dividend tax and high rate dividend tax as well. And the more dividends they earn, of course, then into the higher rate, then obviously into the additional rate as well. So that's how these people pay their tax, really. That's just an example of a case study you might have as a mortgage advisor. But as far as dividends are concerned in the exam, you need to be aware that they are applied at different rates. There's a 2,000 allowance, but effectively they're added on number 3 after people's normal salary, etc., is already worked out. And dividends come in at number 3, which often pushes them up into higher rate anyway. That's as far as CMAP is concerned and dividends. All you really need to know. You don't need to do heavy calculations in the exam. Whatever the book says, you don't, because as a mortgage advisor, that's not our job, is it? People have accountants to do this kind of stuff. That's fair enough. But of course, as a mortgage advisor, you need to appreciate how they're paid and why and how. So when you put the case to the lender, you can just say, look, this guy runs his own business. It's really profitable. And he declares those profits in the form of small salary and dividends. But for all intents and purposes, they are profits in his or her business. Put that case across and you'll be on a winner. A little update for you. Hope that's been useful. Brilliant work. Okay, so that, as you can see, is an update for you. We do a lot of those on our boot camp for you, just to give you an idea. Our CMAP boot camp, we've got a new cohort starting at the end of November. So these people will hopefully get their exams done by sort of early next year is the plan. We're still pumping out some good material for people. We've got live stuff going on as well. We've got drop-ins and live streams and all sorts of things for our CMAP candidates. Got a protection boot camp starting this month as well. That's kicked off already. So if you want to do the protection exams, we've got a boot camp for you there. Our phrase boot camp, by the way, is where you go online and you just watch videos and listen to audios and all that good stuff. It's all very multimedia interactive for you. We have a lot of live stuff as well, because we come on camera with you live to talk to you about how you're getting on. Other than that, I hope you have a good week. We're looking forward to a good week this week as well. Back up to Scotland again at the end of the week, which is nice. Got to see my stepdaughter. Looking forward to that. Got fireworks extravaganza. Up in Scotland, you've got this firework extravaganza on Arthur's Seat. Arthur's Seat is like a mountain in the middle of a city. How cool is that? And it is a mountain too. So you can head up there and have a look at the fire, which is fantastic. I'm looking forward to that a lot as well. Other than that, I hope you're well. Hope you've enjoyed the live stream. We'll be back here again next week, probably Tuesday, because I think I'm still in Scotland on the Monday. Have fun and see you soon. Bye.